Welcome, everyone. Today, we're dissecting the final Federal Reserve meeting of 2025, a session that had the entire market holding its collective breath. All eyes were on the Federal Open Market Committee (FOMC) as we awaited their pivotal interest rate decision, and the lead-up was anything but calm. In the crypto space, for instance, Bitcoin experienced a roller coaster of volatility ahead of the announcement. Its price swung dramatically, at one point dipping to the $91,500 level, only to surge to a high of around $94,500, before ultimately finding a tense equilibrium near the $92,000 mark. This pre-meeting gyration was a clear indicator of the market's anxiety and the high stakes involved in today's pronouncement. As the statement dropped, the Fed revealed its hand, a 25 basis point interest rate cut. While this move will undoubtedly ripple through the global economy, it was not a complete shock to the system. In fact, seasoned market observers were largely prepared for this outcome. The CME FedWatch tool, a closely monitored gauge of market sentiment, had been pricing in a high probability of a rate reduction for weeks. This predictive consensus meant that the cut itself was already factored into many asset prices, preventing a knee-jerk overreaction and allowing for a more nuanced market response. The real story, however, lies not in the decision itself, but in the subtle details, dissenting voices, and forward-looking guidance that accompanied it. Perhaps the most telling detail from this meeting was the significant internal division it exposed within the FOMC. The decision to cut rates was not unanimous. 3 out of the 12 voting members formally dissented, arguing against the reduction. This level of opposition is a rarity for an institution that typically strives for overwhelming, if not complete, consensus. A 3-vote dissent signals a profound divergence of opinion at the highest level of monetary policymaking. It suggests a robust internal debate about the true state of the economy and the appropriate path forward, revealing a fracture between members who believe that the economy needs support and those who fear that easing policy now could reignite inflationary pressures. This internal schism is a critical data point for investors, as it injects a new layer of uncertainty into the Fed's future actions. In his subsequent press conference, Fed Chairman Jerome Powell walked a delicate tightrope, attempting to provide clarity without committing to a specific long-term trajectory. He articulated a range of possibilities for 2026, stating that interest rates could plausibly remain at their new lower level, be reduced further, or even be cut more aggressively depending on incoming data. However, he made one point unequivocally clear: no one on the committee is proposing a rate hike. This statement was a powerful signal to the market, effectively taking the most hawkish scenario off the table for the foreseeable future and providing a floor for investor sentiment. Furthermore, the chairman cast a shadow of doubt on the robustness of the official employment figures. He expressed a degree of skepticism, suggesting that the labor market may not be as resilient as the headline numbers suggest. This is a crucial admission. It implies that the Fed is looking beyond the top-line data and is concerned about underlying weaknesses that could derail the economy. By his assessment, interest rates are currently in what is considered a neutral, neither stimulating nor restricting economic activity, but he acknowledged that by historical standards, they remain high. This commentary paints a picture of a Fed that is cautiously optimistic but acutely aware of the potential for a slowdown, justifying their move to a more accommodative stance. Adding another layer to this dovish tilt, the Federal Reserve announced a significant, albeit carefully worded, change to its balance sheet policy. Starting on December 12th, the Fed will begin repurchasing short-term government bonds. The initial scale of this program is set at approximately $40 billion per month. While the chairman was meticulous in not labeling this move as quantitative easing or QE, it is undeniably a first step toward easing liquidity conditions in the financial system. This action is designed to inject cash back into the banking sector, ensuring that short-term funding markets remain stable and functional. For all intents and purposes, this is a form of QE light, a clear signal that the Fed is not only willing to cut rates, but is also prepared to use its balance sheet to support the economy. When we synthesize all these elements, the rate cut, the internal dissent, the chairman's forward guidance, and the new bond buying program, the overall tone of this meeting can be characterized as neutral, but with a distinct lean towards dovishness. Many market participants had braced for a more hawkish message, fearing that the Fed might signal a one-and-done cut or express greater concern about persistent inflation. Instead, the committee delivered a message that was more accommodative than anticipated. However, this dovishness is conditional. The forecast for interest rates in 2026 remains highly flexible and data-dependent. The Fed has given itself maximum optionality, making it clear that its future decisions will be dictated entirely by the evolution of inflation, employment, and overall economic growth in the months ahead. The market's reaction to this carefully orchestrated announcement was immediate and decisively positive, particularly in the equity markets. Following the release of the Fed's statement and the chairman's press conference, a wave of capital flowed into stocks. The Dow Jones Industrial Average surged, closing the day up by approximately 500 points. The broader S&P 500 index also posted strong gains, rising by about 0.67%. While the tech-heavy Nasdaq Composite added roughly 0.33%, this rally indicates that investors interpreted the Fed's actions and commentary as a green light, viewing the combination of a rate cut and the promise of future liquidity as a supportive backdrop for corporate earnings and stock valuations. In contrast, the Bitcoin market, which had been a hotbed of volatility leading up to the announcement, remained choppy and indecisive in its aftermath. Looking beyond the immediate market gyrations, the long-term impact of this pivotal Fed meeting could be substantial. The official commencement of an interest rate cutting cycle, coupled with the explicit green light for liquidity easing through bond repurchases, creates a more favorable environment for risk assets. Lower borrowing costs and increased money supply have historically been potent tailwinds for markets, including stocks, real estate, and cryptocurrencies. This policy shift could provide the foundation needed for these asset classes to recover and embark on a new phase of growth. However, this optimistic outlook comes with a significant caveat. The path forward is not guaranteed. The Fed has made it abundantly clear that its policy is not on a preset course. Therefore, every piece of macroeconomic data released between now and the next FMC meeting will be scrutinized with extreme intensity. The trajectory of inflation, the health of the labor market, and consumer spending trends will be the ultimate arbiters of the Fed's next move, and by extension, the market's direction for 2026 and beyond. Careful monitoring of this data is no longer just prudent. It is absolutely essential.